tendency toward instability even in relatively normal times. This is shown vividly in the progressive widening of the graphs in Chart A, page 6, found in the accompanying PDF, which trace the fluctuations in general business and industrial stock prices during the years in question. It would be foolhardy to deduce from these developments that we must expect still greater instability in the future, but it would be equally imprudent to minimize the significance of what has happened and to return over readily to the comfortable conviction of 1925 that we were moving steadily towards both greater stability and greater prosperity. The times would seem to call for caution in embracing any theory as to the future and for flexible and open-minded investment policies. With these caveats to guide us, let us proceed to consider briefly certain types of investment problems. A. Investment in high-grade bonds and preferred stocks. Bond investment presents many more perplexing problems today than seemed to be true in 1913. The chief question then was how to get the highest yield commensurate with safety, and if the investor was satisfied with the lower-yielding standard issues, nearly all consisting of railroad mortgage bonds, he could supposedly buy them with his eyes shut and put them away and forget them. Now the investor must wrestle with a threefold problem: safety of interest and principal, the future of bond yields and prices, and the future value of the dollar. To describe the dilemma is easy. To resolve it satisfactorily seems next to impossible. 1. Safety of interest and principal. Two serious depressions in the past 20 years and the collapse of an enormous volume of railroad issues once thought safe beyond question suggests that the future may have further rude shocks for the complacent bond investor. The old idea of permanent investments exempt from change and free from care is no doubt permanently gone. Our studies lead us to conclude, however, that by sufficiently stringent standards of selection and reasonably frequent scrutiny thereafter, the investor should be able to escape most of the serious losses that have distracted him in the past, so that his collection of interest and principal should work out at a satisfactory percentage even in times of depression. Careful selection must include a due regard to future prospects, but we do not consider that the investor need be clairvoyant or that he must confine himself to companies that hold forth exceptional promise of expanding profits. These remarks relate to really high-grade preferred stocks as well as to bonds. 2. Future of interest rates and bond prices. The unprecedentedly low yields offered by both short and long-term bond issues may well cause concern to the investor for other reasons than a natural dissatisfaction with the small return that his money brings him. If these low rates should prove temporary and are followed by a rise to previous levels, long-term bond prices could lose some 25% or more of their market value. Such a price decline would be equivalent to the loss of perhaps 10 years' interest. In 1934, we felt that this possibility must be taken seriously into account because the low interest rates then current might well have been a phenomenon of subnormal business, subject to a radical advance with returning trade activity. But the persistence of these low rates for many years and in the face of the considerable business expansion of 1936 to 1937 would argue strongly for the acceptance of this condition as a well-established result of a plethora of capital or of government fiscal policy or of both. A new uncertainty has been injected into this question by the outbreak of a European war in 1939. The First World War brought about a sharp increase in interest rates and a corresponding severe fall in high-grade bond prices. There are sufficient similarities and differences, both between the 1914 and the 1939 situations, to make prediction too risky for comfort. Obviously, the danger of a substantial fall in bond prices from the level of early 1940 is still a real one, yet a policy of non-investment awaiting such a contingency is open to many practical objections. Perhaps a partiality to maturities no longer than, say, 15 years from purchase date may be the most logical reaction to this uncertain situation. For the small investor, United States savings bonds present a perfect solution of this problem. as well as the one preceding, since the right of redemption at the option of the holder guarantees them against a lower price. As we shall point out in a more detailed discussion, the advent of these baby bonds has truly revolutionized the position of most security buyers. 3. The value of the dollar. If the investor were certain that the purchasing power of the dollar is going to decline substantially, he undoubtedly should prefer common stocks or commodities to bonds. To the extent that inflation, in the sense commonly employed, remains a possibility, the investment policy of the typical bond buyer is made more perplexing. The arguments for and against ultimate inflation are both unusually weighty, and we must decline to choose between them. The course of the price level since 1933 would seem to belie inflation fears, but the past is not necessarily conclusive as to the future. Prudence may suggest some compromise in investment policy to include a component of common stocks or tangible assets, designed to afford some protection against a serious fall in the dollar's value. Such a hybrid policy would involve difficult problems of its own, and in the last analysis, each investor must decide for himself which of the alternative risks he would prefer to run. B. Speculative bonds and preferred stocks. The problems related to this large class of securities are not inherent in the class itself, but are rather derived from those of investment bonds and of common stocks between which they lie. The broad principles underlying the purchase of speculative senior issues remain, in our opinion, the same as they always were. 1. A risk of principal loss may not be offset by a higher yield alone, but must be accompanied by a commensurate chance of principal profit. 2. It is generally sounder to approach these issues as if they were common stocks, but recognizing their limited claims, than it is to consider them as an inferior type of senior security. C. The problem of common stock investment. Common stock speculation, as the term has always been generally understood, is not so difficult to understand as it is to practice successfully. The speculator admittedly risks his money upon his guess or judgment as to the general market or the action of a particular stock, or possibly on some future development in the company's affairs. No doubt the speculator's problems have changed somewhat with the years, but we incline to view that the qualities and training necessary for success, as well as the mathematical odds against him, are not vitally different now from what they were before. But stock speculation, as such, does not come within the scope of this volume. Current practice. We are concerned, however, with common stock investment, which we shall define provisionally as purchases based upon analysis of value and controlled by definite standards of safety of principle. If we look to current practice to discern what these standards are, we find little beyond the rather indefinite concept that a good stock is a good investment. Good stocks are those of either 1. Leading companies with satisfactory records, a combination relied on to produce favorable results in the future, or 2. Any well-financed enterprise believed to have especially attractive prospects of increased future earnings. As of early 1940, we may cite Coca-Cola as an example of 1, Abbott Laboratories as an example of 2, and General Electric as an example of both. But although the stock market has very definite and apparently logical ideas as to the quality of the common stocks that it buys for investment, its quantitative standards governing the relation of price to determinable value are so indefinite as to be almost non-existent. Balance sheet values are considered to be entirely out of the picture. Average earnings have little significance when there is a marked trend. The so-called price-earnings ratio is applied variously, sometimes to the past, sometimes to the present, and sometimes to the near future. But the ratio itself can scarcely be called a standard, since it is controlled by investment practice instead of controlling it. In other words, the right price-earnings ratio for any stock is what the market says it is. We can find no evidence that at any time from 1926 to date, common stock investors as a class have sold their holdings because the price-earnings ratios were too high. How the present practice of common stock investors, including the investment trusts almost without exception, can properly be termed investment in view of this virtual absence of controlling standards is more than we can fathom. It would be far more logical and helpful to call it speculation in stocks of strong companies. Certainly, the results in the stock market of such investment have been indistinguishable from those of old-time speculation, except perhaps for the margin element. A striking confirmation of this statement, as applied to the years after the 1929 crash, is found by comparing the price range of General Electric since 1930 with that of common stocks generally. The following figures, found in the accompanying PDF, show that General Electric Common, which is perhaps the premier and undoubtedly the longest entrenched investment issue in the industrial field today, has fluctuated more widely in market price than have the rank and file of common stocks. It was little short of nonsense for the stock market to say in 1937 that General Electric Company was worth $1,870,000,000, and almost precisely a year later that it was worth only $784 million. Certainly nothing had happened within 12 months' time to destroy more than half the value of this powerful enterprise, nor did investors even pretend to claim that the falling off in earnings from 1937 to 1938 had any permanent significance for the future of the company. General Electric sold at 64 7/8 because the public was in an optimistic frame of mind, and at 27 1/4 because the same people were pessimistic. To speak of these prices as representing investment values or the appraisal of investors is to do violence either to the English language or to common sense or both. 4 problems. Assuming that a common stock buyer were to seek definite investment standards by which to guide his operations, he might well direct his attention to 4 questions. 1. The general future of corporation profits. 2. The differential in quality between one type of company and another. 3. The influence of interest rates on the dividends or earnings return that he should demand. And finally, 4. The extent to which his purchases and sales should be governed by the factor of timing as distinct from price. The general future of corporate profits. If we study these questions in the light of past experience, our most pronounced reaction is likely to be a wholesome skepticism as to the soundness of the stock market's judgment on all broad matters relating to the future. The data in our first table show quite clearly that the market underestimated the attractiveness of industrial common stocks as a whole in the years prior to 1926. Their prices generally represented a rather cautious appraisal of past and current earnings, with no signs of any premium being paid for the possibilities of growth inherent in the leading enterprises of a rapidly expanding commonwealth. In 1913, railroad and traction issues made up the bulk of investment bonds and stocks. By 1925, a large part of the investment in street railways had been endangered by the development of the automobile. But even then, there was no disposition to apprehend a similar threat to the steam railroads. The widespread recognition of the factor of future growth in common stocks first asserted itself as a stock market influence at a time when, in fact, the most dynamic factors in our national expansion, territorial development, and rapid accretions of population were no longer operative, and our economy was about to face grave problems of instability arising from these very checks to the factor of growth. The overvaluations of the new era years extended to nearly every issue that had even a short period of increasing earnings to recommend it, but a special favor was accorded to the public utility and chain store groups. Even as late as 1931, the high prices paid for these issues showed no realization of their inherent limitations, just as 5 years later the market still failed to appreciate the critical changes taking place in the position of railroad bonds as well as stocks. Quality differentials. The stock market of 1940 has its well-defined characteristics, founded chiefly on the experience of the recent past and on the rather obvious prospects of the future. The tendency to favor the larger and stronger companies is perhaps more pronounced than ever. This is supported by the record since 1929, which indicates, we believe, both better resistance to depression and a more complete recovery of earning power in the case of the leading than of the secondary companies. There is also the usual predilection for certain industrial groups, including companies of smaller size therein. Most prominent are the chemical and aviation shares, the former because of their really remarkable record of growth through research, the latter because of the great influx of armament orders. But these preferences of the current stock market, although easily understood, may raise some questions in the minds of the skeptical. First to be considered is the extraordinary disparity between the prices of prominent and less popular issues. If average earnings of 1934 to 1939 are taken as a criterion, the good stocks would appear to be selling about 2 to 3 times as high as other issues. In terms of asset values, the divergence is far greater, since obviously the popular issues have earned a much larger return on their invested capital. The ignoring of asset values has reached a stage where even current assets receive very little attention, so that even a moderately successful enterprise is likely to be selling at considerably less than its liquidating value if it happens to be rich in working capital. The relationship between good stocks and other stocks must be considered in the light of what is to be expected of American business generally. Any prediction on the latter point would be highly imprudent, but it is in order to point out that the record of the last 15 years does not in itself supply the basis for an expectation of a long-term upward movement in volume and profits. Insofar as we judge the future by the past, we must recognize a rather complete transformation in the apparent outlook of 1940 against that in 1924. In the earlier year, a secular rise in production and a steady advance in the figure taken as normal were accepted as a matter of course. But so far as we can see now, the 1923 to 1925 average of industrial production, formerly taken as 100 on the Federal Reserve Board's index, must still be considered as high and normal as we have any right to prognosticate. Needless to say, the investor will not deny the possibility of a renewed secular rise, but the important point for him is that he cannot count upon it. If this is the working hypothesis of the present stock market, it follows that stock buyers are expecting in general a further growth in the earnings of large companies at the expense of smaller ones, and of favorably situated industries at the expense of all others. Such an expectation appears to be the theoretical basis for the high price of the one group and the low prices found elsewhere. That stocks with good past trends and favorable prospects are worth more than others goes without saying. But is it not possible that Wall Street has carried its partiality too far? In this, as in so many other cases, may not the typical large and prosperous company be subject to a twofold limitation? First, that its very size precludes spectacular further growth. Second, that its high rate of earnings on invested capital makes it vulnerable to attack, if not by competition, then perhaps by regulation. Perhaps also the smaller companies and the less popular industries as a class may be definitely undervalued, both absolutely and in relation to the favored issues. Surely this can be true in theory, since at some price level the good stocks must turn out to have been selling too high and the others too low. There are strong, if not conclusive, reasons for arguing that this point may have already been reached in 1940. The two possible points of weakness in the good stocks are paralleled by corresponding favorable possibilities in the others. The numerous issues selling below net current asset value, even in normal markets, are a powerful indication that Wall Street's favoritism has been overdone. Finally, if we carry the analysis further, we must realize that the smaller listed companies are representative of the hundreds of thousands of private enterprises of all sizes throughout the country. Wall Street is apparently predicting the continued decline of all business, except the very largest, which is to flourish mightily. In our own opinion, such a development appears neither economically probable nor politically possible. Similar doubts may be voiced as to the stock market's emphasis on certain favored industries. This is something that, by the nature of the case, must always be overdone, since there are no quantitative checks on the public's enthusiasm for what it likes. Not only has the market invariably carried its optimism too far, but it has shown a surprising aptitude for favoring industries that soon turned out to be facing adverse developments. Witness the baking stocks in 1925, the radio and refrigeration issues in 1927, the public utility and chain stores in 1928 to 1929, the liquor issues in 1933. It is interesting to compare the investor's eagerness to buy Abbott Laboratories in 1939 and his comparative indifference to American home products, the one kind of pharmaceutical company being thought to have brilliant and the other to have only mediocre prospects in store. This distinction may prove to have been soundly and shrewdly drawn, but the student who remembers the market's not-so-remote enthusiasm for American home products itself and its companions, particularly Lambert, in 1927, can hardly be too confident of the outcome. Interest rates. Coming now to the third point of importance, viz., the relation between interest rates and common stock prices, it is clear that if current low bond yields are permanent, they must produce a corresponding decline in average stock yields and an advance in the value of $1 of expected earning power as compared with the situation, say, in 1923 to 1925. The more liberal valuation of earnings in 1936 to 1938, as shown by the data relating to the Dow Jones Industrial Average on page 22, would thus appear to have been justified by the change in the long-term interest rate. The disconcerting question presents itself, however, whether or not the fall in interest rates is not closely bound up with the cessation of the secular expansion of business and with the decline in the average profitability of invested capital. If this is so, the debit factors in stock values generally may outweigh the credit influence of low interest rates, and a typical dollar of earning power in 1936 to 1938 may not really have been worth more than it should have been worth a decade and a half previously. The factor of timing. Increasing importance has been ascribed in recent years to the desirability of buying and selling at the right time, as distinguished from the right price. In earlier periods, when the prices of investment issues did not usually fluctuate over a wide range, the time of purchase was not considered of particular importance. Between 1924 and 1929, a comfortable but quite misleading confidence developed in the unlimited future growth of sound stocks, so that any mistake in timing was sure to be rectified by the market's recovery to ever higher levels. The past decade has witnessed very wide fluctuations without a long-term upward trend, except in a relatively small number of issues. Under these conditions, it is not surprising that successful investment seems, like successful speculation, to be bound up inescapably with the choice of the right moment to buy and to sell. We thus find that forecasting of the major market swings appears now to be an integral part of the art of investment in common stocks. The validity of stock market forecasting methods is a subject for extensive inquiry and perhaps vigorous controversy. At this point, we must content ourselves with a summary judgment, which may reflect our own prejudices along with our investigations. It is our view that stock market timing cannot be done with general success unless the time to buy is related to an attractive price level as measured by analytical standards. Similarly, the investor must take his cue to sell primarily not from so-called technical market signals, but from an advance in the price level beyond a point justified by objective standards of value. It may be that within these paramount limits there are refinements of stock market technique that can make for better timing and more satisfactory overall results. Yet we cannot avoid the conclusion that the most generally accepted principle of timing, viz., that purchases should be made only after an upswing has definitely announced itself, is basically opposed to the essential nature of investment. Traditionally, the investor has been the man with patience and the courage of his convictions who would buy when the harried or disheartened speculator was selling. If the investor is now to hold back until the market itself encourages him, how will he distinguish himself from the speculator? And wherein will he deserve any better than the ordinary speculator's fate? Conclusion. Our search for definite investment standards for the common stock buyer has been more productive of warnings than of concrete suggestions. We have been led to the old principle that the investor should wait for periods of depressed business and market levels to buy representative common stocks, since he is unlikely to be able to acquire them at other times except at prices that the future may cause him to regret. On the other hand, the thousands of so-called secondary companies should offer at least a moderate number of true investment opportunities under all conditions, except perhaps in the heyday of a bull market. This wide but quite unpopular field may present the more logical challenge to the interest of the bona fide investor and to the talents of the securities analyst. Part 1. Survey and Approach. Introduction to Part 1. Benjamin Graham, In His Time and Ours, by Roger Lowenstein. Of all the stocks Benjamin Graham bought over the course of his career, none were more influential than the odd lot of U.S. Steel purchased by his mother. Left a widow in 1904, she tried to keep up her husband's import business, then ran a boarding house. Both efforts failed. In 1907, with bullish sentiment riding high, she purchased Steel on margin. Later that year, Wall Street succumbed to a panic, and her account was wiped out. Such was 13-year-old Ben's introduction to investing. Graham was to learn the lesson more than once. His early history is important because it was the source of his insight into investing. He grew up in New York City and managed to attend Columbia University despite his family's meager savings. Upon graduation, the deans of 3 departments, mathematics, philosophy, and English, offered him teaching jobs, but the dean of Columbia College liked to send prize pupils downtown to Wall Street. Graham went to work in 1914 in the bond department of Neuberger, Henderson, and Loeb at $12 a week. World War I erupted months later. Although the war cast a pall on Wall Street, as it became clear that America was to provision Europe, the market turned bullish. Graham tackled securities with the same intellectual curiosity he had displayed in school. Corporate information in that pre-regulatory era was scarce. Investors in stocks were not truly investors. They were speculators betting on trends. Graham was different. Almost from the first, he took to analyzing securities on the basis of their asset value, though obtaining information required considerable sleuthing. One early success was Guggenheim Exploration Company, which, as Graham divined, owned a collection of valuable mining stocks underappreciated by Wall Street. By 1916, the 22-year-old Graham, still on salary at Neuberger, was also managing investments for one of his professors. Many of Graham's investments were arbitrages such as Guggenheim, objectively a bargain. This led him to feel secure. Alas, in the fall of 1916, stocks entered a prolonged decline. Despite his mother's example, Graham had purchased on margin. He was forced to sell at a loss and spent 2 painful years recouping the professor's capital. Such cycles recurred throughout his career. Indeed, they recur to this day. Graham grasped, at a remarkably young age, the cardinal distinction between investment and speculation, but even for him, good times loosened the strings of prudence. Before he was 30, he had left Neuberger to run a money management venture, Graer Corporation. His reputation for spotting arbitrage and hedging opportunities spread quickly. One example, DuPont, which owned a controlling interest in General Motors, was selling for no more than the value of its investment in GM, thus according no value to its chemical business. To Graham, that was low-hanging fruit, but Wall Street to him was more than a mathematical exercise. He had a knack for stripping complicated securities to their essence. He realized early on that value does not reside in the form of a security, but in the hierarchy and value of its claim on the underlying assets. While still at Neuberger, he concluded that many convertible stocks offered the same potential profits as the common stock, but with less downside. He applied this insight to Consolidated Textile, acquiring its 7% convertible bond, which he judged to be safe, and selling short the common stock, a speculative favorite due to the allure of its various cotton mills. Ben warned his senior partner who owned the common that he was taking a risk, but the partner said he preferred an active stock to a stodgy bond. Within a year, the common plunged from 70 to 20, while the convertible was, soon, redeemed at a premium. With fast accumulating experience, Graham began to think of himself as a teacher as well as practitioner. By 1919, the precocious apprentice was writing pamphlets entitled Lessons for Investors. In 1925, he decided to write a book imparting his investment knowledge. Fortunately, he later recalled, "I had the inspiration to learn more on the subject." Nothing he might have written then could have resembled the volume now in your hands that he was to write 7 years later. That he did wait is, of course, what makes security analysis so relevant today. The late 1920s were a heady time on Wall Street. The new era of stocks that did not go down, only up, was gathering momentum. Graham instinctively was cautious. He bought only those stocks that he judged, on the basis of laborious research, worth considerably more than their price. His renown also grew. In 1926, he traveled to Washington and discovered through reading obscure filings at the Interstate Commerce Commission that Northern Pipeline, a former part of the Standard Oil Trust, was sitting on $95 a share in securities such as railroad bonds. This was unknown to the public, and the stock foundered at 65. Graham, now operating a partnership with Jerry Newman, patiently bought 170,000 shares and pressured the company to divest the securities and pay a large dividend. When management resisted, he launched a proxy fight and won a board seat. Several distributions totaling $110 a share followed, a huge windfall. Graham's pursuit of Northern and of other former Standard Oil subsidiaries brought him into contact with the eminent financier Bernard Baruch. Graham recommended ostensibly safe stocks, and Baruch gobbled them up. As the bull market accelerated, Baruch and Graham each worried about the evident excess. Baruch observed that it was absurd for the Dow Jones Industrials to be yielding only 2% when short-term fixed income securities were yielding 8%. Graham tellingly replied, "By the law of compensation, someday the reverse should happen." Yet Graham was not quite prepared. In 1928, his partnership, the Benjamin Graham Joint Account, gained 60%, besting even the 49% rise in the Dow. Ben's share of the profits topped $600,000, nearly 10 times what Babe Ruth was making at the time. Graham had also begun teaching an evening course at Columbia. Many of his students were Wall Street pros eager for tips. Seemingly, Graham was on top of the world. In October 1929, however, the market broke. In 1930, when Graham presumed the worst was over, the joint account invested heavily, again on margin. According to Irving Kahn, his assistant, Graham did not realize that all operations involving borrowing, including his own, were at risk. The selling was far from over. By 1932, the depths of the Great Depression, the joint account had fallen 70%. Graham and Newman went 5 years without salary. Graham's wife returned to work as a dance instructor, and the family abandoned their posh Central Park duplex for a rear apartment. It was then that Graham and Columbia's David Dodd signed with McGraw-Hill to write security analysis. Although Dodd, then an assistant professor, was generously credited by Graham as co-author, in fact, he was Graham's assistant. Graham wrote the text, and Dodd checked facts, offered suggestions, and so forth. It was an extraordinary time to write an investment manual. A third of American industry was selling at less than its liquidation value. Many so-called experts discounted the notion of investing in stocks at all. Any stock purchase, they asserted, was sheer speculation. Yet Graham had the courage to recognize a buying opportunity. Hard-won wisdom had honed his belief that the market trend was a fickle barometer. The stock market is not a weighing machine, he wrote. It was a voting machine in which countless individuals' registered choices produced partly of reason and partly of emotion. Security analysis was written to help investors appraise a security's enduring value and divorce themselves from momentary passions. It breathes with the wisdom of the author's classical training. Graham turned to Horace, the Roman poet, for his epigraph. Many shall be restored that now are fallen, and many shall fall that are now in favor. The metaphor was almost too good. Underlying values could not be judged on the basis of their price, for prices were as fleeting as the fates. That enormous profits should have turned into still more colossal losses, that unlimited optimism should have been succeeded by the deepest despair, no longer struck Graham as surprising. The serious investor, therefore, had to trust in the long-term values reflected not by the stock price or predictions about the price, but by the intrinsic corporate worth, to be discerned from the balance sheet, earnings reports, and other sources. This insight is no less true today than it was in 1934, yet the majority of investors approached the market with little trace of the enlightenment that prior experience might have taught. The list of investment fads and bubbles in the late 20th and early 21st century has become well too long to enumerate. From the vantage of 2022, investors were confronted by a pandemic that shuttered the economy, a deadly war in Europe, and a rapid revival of domestic inflation. The first was utterly outside the experience of contemporary investors. The other two seemed ghosts from a distant past. These multiple shocks were a reminder that, along with many calculable risks such as interest rate movements, investors face uncertainties that defy anticipation, much less arithmetic estimation. This argues for investors, even those in reputedly safe stocks, to build in a layer of protection, what Graham memorably termed a margin of safety. It is tempting to wonder, if Ben Graham were writing this book today, what would he be saying? The question is unanswerable, but we can make a useful distinction. Although we cannot guess how he would assemble a portfolio, investors can still apply his approach. The axiom that market prices convey little about the future that is useful or lasting is as valid as ever. The truism that any trend is subject to reversal still suggests an urgent need for a margin of safety. Graham would not recognize software or digital apps, but he would, I suspect, find much familiar in the markets of 2007 to 2022, during which the Standard & Poor's 500 index crashed 3 times, once by half and another time by a third, and yet overall rose a remarkable 11% per annum, with price-earnings ratios rising to levels close to those of 1929. On the recent fetish for so-called private equity, Graham, we imagine, would have pointed out that the distinction between such investments and traditional public stocks was chiefly superficial, one of form. Substantively, each consists of an ownership interest whose value ultimately depends on a business's performance. It is true that private equities, which are not quoted daily or hourly, present a less volatile surface, but the underlying businesses are subject to the same fundamental pressures. In 2022, these included rising interest rates, inflation, at least 2 consecutive quarters of declining GDP, volatile energy prices, labor shortages, persistent supply chain delays, and the war in Ukraine. Public shares fell 23% over the first half of the year, yet private equity managers were still touting past rosy returns. Beneath the surface, the $3.3 trillion in private equities, most of it invested at elevated prices, faced the same pressures. An index that mapped the public stock equivalents of private equity portfolios had fallen 37%. To the extent that past performance of private equity benefited from their considerably higher levels of debt, Graham would have shuddered. As he knew, debt is a double-edged sword. It magnifies returns on the way up, but imposes killer costs as interest rates rise or alternatively as business slows. The U.S. economy was experiencing both, and slowdowns appeared to be underway in Europe, Britain, and China as well. Graham would also have been mystified by the phenomenon known as meme stocks. In the early 2020s, these attracted considerable followings and valuations on the sole basis of social media promotion. The most celebrated of these, GameStop, a chain of video game stores operating at a loss, caught the attention of small investors who traded on a mobile trading app. The small investors trumpeted their lack of investing experience as a badge of honor. Some asserted that their motive was less profit than to inflict losses on professional investors who had sold the stock short. In a matter of months, GameStop shares vaulted from single digits to $483, representing a total valuation of more than $30 billion. The retail investors were egged on by celebrity touts such as Jim Cramer, a television financial commentator, and billionaire Elon Musk, and encouraged by elected officials who imagined that they represented a populist crusade against Wall Street. One best-selling author portrayed the GameStop buying panic as a millennial version of the French Revolution. In the event, the stock plunged to a fraction of its peak, though as of late 2022 still considerably higher than before. A more substantive phenomenon than meme stocks was the craze for special-purpose acquisition vehicles, SPACs. We'll discuss SPACs at some length, not because they were truly special, but rather they were so illustrative of the way that Wall Street, in Graham's day and in ours, goes off the rails. A clever, if minor, financial innovation is exploited by those with pecuniary interest and sold to investors whose desire for large and swift profits blinded them to the utter lack of a fundamental basis, that is, of a margin of safety. For a brief moment in 2020 and 2021, SPACs transformed the market for initial public offerings. As with private equity, the novelty of SPACs was one of form, not substance. Private companies have been raising capital via IPOs since the early days of Wall Street. What distinguished SPACs was a twist on the usual sequence. Normally, at some point after starting a business, insiders go to Wall Street and try to raise money. SPACs inverted the order. First, Wall Street raised the money, then the sponsors looked for a company in which to deploy it. Even a novice to Wall Street, maybe especially a novice, will detect a certain illogic to this way of doing things. Perhaps in no area of recent finance was Ben Graham so sorely missed, because despite considerable press coverage, most of it fawning, the risks to investors in SPACs were widely overlooked. SPACs are paper corporations that sell shares in IPOs, customarily priced at $10 a share. Unlike a traditional IPO, a SPAC raises capital not for an operating business, it has none, but for a corporate shell that is obligated to purchase an operating business, generally within 18 or 24 months. If the SPAC is unable to complete an acquisition, the investors get their money back in full, and the SPAC is liquidated. Moreover, when the SPAC agrees to acquire a target, investors have the option of redeeming for $10 a share plus interest. Those who do not redeem will own a share in the newly merged business. In other words, the SPAC investors get a free look. Actually, their situation is even better than that. Original investors in a SPAC not only get a share for their $10, they also get a fractional warrant. Since holders who redeem may keep the warrants, redeeming investors even retain some upside. Clearly, there is a carrot for SPAC investors, but it is fair to ask, who is paying for this seemingly free lunch, and why? SPACs do not materialize out of thin air. They are formed by a sponsor, generally an investor group or other financial operator. In return for organizing the SPAC, the sponsor takes a 20% slice of the SPAC essentially for free, although it does have to invest some millions in setting it up. Thus, the sponsor has a powerful incentive to find a target company and execute a merger. Otherwise, the SPAC liquidates and its investment is lost. The free lunch for the SPAC investors serves as an inducement to attract capital and get the project going. And they are not the only ones getting lunch. The sponsor needs a Wall Street bank or banks to underwrite the initial sale of shares, and the investment bank charges a 2% fee on the underwriting and another 3.5% if the SPAC completes an acquisition. The SPAC is also subject to various advisory, legal, and other fees. Adding up these sundry expenses, it should be clear that the SPAC is burdened with considerable costs. Not surprisingly, in light of their complexity, SPACs were only a tiny outpost on Wall Street and not an especially reputable outpost. That SPACs existed at all is owed to the interest of a party we have not yet considered, the target company that the SPAC acquires. The targets were generally small private firms, often early startups. Many were too speculative to raise money in a conventional IPO. For this small niche of companies, SPACs offered a decided, though unintended, advantage. In an ordinary IPO, the underwriters cannot offer forecasts of future earnings, revenue, and so forth without incurring great risk of litigation. This is for good reason. Insiders selling stock are anything but neutral parties. Their forecasts are naturally prone to optimism, and the company being private, the insiders are the only source of information. Since the public is effectively at their mercy, regulators do not grant IPOs the customary safe harbor to issue forward-looking statements. In the case of a SPAC, however, due to an inadvertent loophole in securities regulation, no such restraint exists. Recall that a SPAC's progress to maturity consists of two transactions. First, a corporate shell raises capital by selling shares. Technically, this is its IPO, but scrutiny is hardly an issue because the SPAC has no assets to scrutinize. In the second stage, the SPAC purchases a private business. Although this purchase has the effect of taking the target public, the merger technically is not an IPO because the SPAC has already gone public. Thus, the process offers an end run around the normal IPO requirements. Worrisomely, it deprives the public of regulatory protection. For many years, SPACs were inconsequential. In 2016, only 13 SPACs went public compared to 75 ordinary IPOs. Then volume began to creep up. By 2019, Wall Street was minting a SPAC a week. Richard Branson was able to find a SPAC buyer to the tune of $800 million for equity in Virgin Galactic, a space tourism company with no revenue. Wall Street noticed the fees. In April 2020, DraftKings, a sports fantasy and betting company with a prior history of regulatory trouble, went public via a SPAC. Suddenly, SPACs were hot. When COVID-19 lockdowns put the economy into recession and the Federal Reserve started pumping liquidity into markets, speculators armed with cheap money flocked to SPACs. According to Christy Marvin, CEO of SPAC Insider, everybody wanted one. Valuations went through the roof. Traditionally, investors in SPAC IPOs were financial buyers such as hedge funds. The hedge funds either redeemed when an acquisition was announced or, if the price was favorable, sold to other investors. In 2020, interest broadened to retail buyers and institutions, sometimes denoted as SPAC tourists. The question for whomever owned the stock was simple. Post-merger, were the shares likely to trade above $10? If not, investors were better off redeeming. For them, exit was preferable to a bad deal. The calculus for the sponsor was quite different. Financial structures in which incentives are misaligned often lead to trouble, and the incentives in SPACs were badly misaligned. The sponsor naturally hoped to acquire an attractive business at a favorable price. But for the sponsor, even a bad deal was preferable to no deal at all. Its shares would still be worth a good deal more than it had paid, which was zero. Whereas if no deal transpired, it would lose the millions it had spent establishing the SPAC. The possibility of redemption hung over each party like a sword, but in different ways. Redemptions weakened the capital structure and shrunk the base over which those hefty costs were spread. If half the shares were redeemed, a 5.5% underwriting fee became equal to 11% fee on the capital remaining. Since each shareholder that redeemed increased the burden on those that remained, the SPAC structure spawned a potential race for the exits. For the sponsor, having no exit option, the paramount goal was to minimize redemptions and retain as much cash as possible in the business. Some SPAC sponsors cut preferential, secretive deals with large shareholders in which the shareholders agreed not to redeem. Sponsors also raised private capital, again on preferential terms, to replace the capital that was redeemed. Sponsors went to great lengths to develop a public market for the shares so that exiting shareholders could sell rather than redeem. Practically, this meant persuading the public that the merged entity would trade above $10. This presented an almost insoluble problem. As a matter of math, SPAC shares pre-merger were clearly worth less than $10. After all, its only tangible assets consisted of the $10 per share raised in the IPO, less its considerable costs. How could a merger elevate its value? One solution would be to purchase a target company at a bargain price so that the per-share value of the merged enterprise would be higher. But bargains do not come on trees. The target shareholders naturally want to receive fair value for their business. In fact, target companies are in a position to demand more than fair value because they know that sponsors need to do a deal. Another possibility was that merely taking the target company public would enhance its value, possible in theory, though not very likely in practice. Or perhaps the expertise and talent of the sponsor executives who commonly go on the company's board is such that the target business will, under their tutelage, improve. Investors, being impressionable, often simply assumed that sponsors were intelligent and working in the investors' interests. Disclosure was opaque, and few investors were aware of the total of embedded costs. According to a study of all SPACs that merged over an 18-month period when SPACs were hot, after accounting for the sponsor's interest, the investor warrants, the banker's fees, and other fees, the median public investor's interest had been diluted to only $5.70 of the initial $10. This amounted to a whopping 43% reduction in intrinsic value. Not only were investors unaware of the expenses, many had believed that SPACs were cost-effective compared with conventional IPOs, when in fact they were considerably more expensive. Michael Klausner, a Stanford Law School professor who examined SPACs in detail, found that SPACs are far less transparent than they could be with respect to their embedded costs. Owing to the holes in applicable regulation, sponsors had the motive and the opportunity to aggressively promote their mergers. The sponsors conducted roadshows to sell their deals, similar to roadshows for conventional IPOs, except that SPACs were free to indulge in optimistic, at times wildly optimistic, forecasts. Coinciding with the post-economic stimulus market rally in the second half of 2021, Wall Street's eagerness to exploit this loophole was unrestrained. Many SPACs were promoted by celebrities, such as the rapper Sean Jay-Z Carter for a cannabis company, investor and reality television personality Matt Higgins, home decor celebrity Martha Stewart, hedge fund titan Bill Ackman, quarterback Patrick Mahomes, and tennis star Serena Williams. SPACs were financed by the bluest chip underwriters, led by Citigroup, Goldman Sachs, and Credit Suisse. Promotion of SPAC mergers was unblushing. Nikola, an electric truck startup, released a video of a truck barreling downhill embedded in a tweet reading, "Behold, the Nikola One in motion." According to the SEC, the video was posted on Nikola's corporate Twitter and Facebook accounts in early 2018, prior to its May 2018 SPAC merger, and it remained posted and available to investors at least until September 2020. Investors thought they had found the next Tesla, and the stock soared to 73, making it more valuable than Ford, although it had yet to sell a single vehicle. According to an SEC cease and desist order issued 18 months after its SPAC merger, Nikola had made scores of misrepresentations to inflate its stock price. In particular, it omitted the detail that the truck in the video was not powered by a Nikola battery or any Nikola part. It was rolling under the influence of gravity. After the fraud was revealed, the stock crashed. Although Nikola was an extreme case, it was common for SPACs to project sharply rising revenue and profits for targets that had little actual business. Dozens of SPAC deals subsequently and quickly missed their forecasts. The CEO of a rival SA, an electric bus company — electric vehicles were a hot sector for SPACs — forecast ahead of its March 2021 merger that revenue would surge from $0 to $14 billion in 3 years. Later that year, the CEO said, simply and devastatingly, "We withdraw our long-term forecasts." View, a company that made sunlight-sensitive windows, compared itself in an investor presentation to Tesla and Amazon. After its merger with a SPAC, the happy talk ceased. In 2020, 248 SPACs raised $83 billion, an enormous sum, indeed more than in the entire previous decade. In 2021, 613 SPACs raised $162 billion, and more SPACs went public than traditional IPOs. The mania reached such a fever that the average SPAC climbed to $11.50 per share prior to any merger announcement, meaning that cash held by a SPAC, though depleted by significant costs, was trading at a 15% premium to the cash in one's pocket. Investors were giving sponsors a blank check based on credulity or faith. Many reckoned, in so many words, "They are smart people, they will find something." Of course, each individual investor believed he or she was behaving rationally. They had the comfort of the redemption option, the free look, and if the stock was trading over 10, why should they redeem? At the height of the mania, shares of SPACs post-merger announcement soared to an average of $15.77 per share. Not surprisingly, given the glorious returns, 4 of 5 SPAC investors chose not to redeem. Alas, in the spring of 2021, companies that had merged with SPACs, now being public, were exposed for all to see, and performances did not live up to expectations. The bubble cracked and SPAC prices tumbled. As enthusiasm wilted, more than half of investors in forthcoming SPAC mergers chose to redeem. Volume in new SPAC issues withered. In July 2022, for the first month in 5 years, not a single new SPAC went to market. Existing SPACs found it increasingly hard to negotiate mergers acceptable to both target companies and to investors. Of the 613 SPACs that went public in 2021, more than 70% were, with increasing desperation, still searching for a target in September 2022. Many of those presumably will be forced to liquidate. Their investors will get their money back, but shareholders in completed mergers were not so fortunate. By September 2022, the average price of SPACs that had raised money in 2020 and 2021 and completed a merger had plummeted to a mere $5.03. Not only had investors lost half their capital on average, but the losses were widely shared. Of the hundreds of SPACs that completed a merger since the start of 2020, fewer than 15% were trading at the break-even price of $10 a share. More than 70 fell to less than $2. Even in relative terms, SPACs significantly underperform both the NASDAQ and conventional IPOs. In contrast to these losses, the sponsors made, on average, more than $100 million per deal. Even in deals that lost money for public investors, the sponsors typically cleared millions of dollars. Wall Street was richly rewarded for enabling the bubble from the start of 2020 through the third quarter of 2022. Underwriters pocketed an estimated $8 billion in fees. In March 2022, that is, after the bubble burst, the SEC belatedly proposed regulatory reforms that would tighten disclosure requirements and make it easier to sue when SPAC projections missed the mark. Goldman Sachs promptly reduced its footprint in the industry, citing the changed regulatory environment. On form, if SPACs could no longer mislead investors, Wall Street was no longer so game. A backward glance at the bubble suggests that the only purpose of SPACs was to provide targets a back door to going public, which came at the considerable cost of sidestepping securities regulations and the attendant risk of capital misallocation and investor losses. The majority of initial SPAC investors protected themselves by redeeming or selling, but the investors who took their places, those who chose not to redeem, wound up underwriting the various other parties, in particular the targets. Professor Klausner concluded, SPAC shareholders that choose not to redeem unwittingly subsidize the firms they bring public. The SPAC bubble, though instructive, was brief. It was overshadowed by the more enduring speculation in cryptocurrencies. While Graham would have blinked uncomprehendingly at Bitcoin, he would have recognized, almost as though reading a page from the Roaring Twenties, the self-interested promotion by Wall Street institutions and the herd-like credulity of small investors. Bitcoin and other crypto assets were touted as an alternate currency, the currency of the future, apparently spawned by an ideological desire to create a currency free of government involvement. However, only El Salvador made Bitcoin its legal tender, a decision disclosed by its 40-year-old president while attending a Bitcoin conference in Miami. Investing in its new money, the Central American nation promptly incurred an unrealized loss of 50%. Even in Salvador, virtually no one uses Bitcoin to pay for goods and services. They use, in fact, the U.S. dollar. In the United States, millions of people have purchased crypto, but similarly, it plays no role in the economy. People do not think of it as a currency or benchmark. They track the price of crypto in dollars, not the reverse. Bitcoin is transacted far too slowly to serve as a medium for electronic payments. Visa and MasterCard are thousands of times faster. The blockchain platforms that support crypto are ingenious and might potentially serve some additional purposes. A few investment banks trade debt securities on blockchain networks. However, a fact often ignored, investors in cryptocurrency do not own a claim on the technology. They own a code to, and only to, their own coin. What Bitcoin has proved useful for is illicit transfers by drug cartels, kidnappers, pornographers, and the like. As Eswar Prasad, a Cornell University professor and digital expert, told this writer, Bitcoin remains a pure speculative asset whose whole value is based on scarcity. The only reason it has value is everyone else thinks it has a value. Few speculative vehicles have attained such widespread popularity. Scores of coins have been digitally minted, worth well over $1 trillion at market prices. Yet no one has offered a definition, even an approach, to ascertaining any intrinsic value to these coins. They produce no revenue, dividends, or cash flow. They yield no earnings. Like the tulip mania in 17th century Holland, they are purchased in the hope that other buyers will pay more. To borrow an example from the organizing editor of this volume and my fellow contributor, Seth Klarman, they are like the West Coast sardines whose price soared well beyond what any sane consumer would pay because, a speculator explained, these were not eating sardines, they were trading sardines. Tulip and sardine prices are anchored by the cost of other tangible goods, other flowers, or other seafood. Crypto is untethered speculation. Over a 6-month span in 2021 and 2022, Bitcoin traded above $67,000 and then collapsed to under $20,000. There is no rational way of determining if either price was correct or that any price is. Bitcoins are for trading, not eating. Leading investment firms once shunned crypto as speculative and risky, unsuitable for clients. Mimicking the behavior of brokers in the 1920s, they soon cashiered their so-called principles. The big investment banks established crypto departments to promote or enable speculative trading. Wall Street goes where the money is. Matthew McDermott, global head of digital assets at Goldman Sachs, proclaimed that Goldman would expand in crypto to meet investor demand. When crypto prices plunged, McDermott said, "Seeing moves like this in this environment doesn't come as a huge surprise." It would be interesting to hear if Goldman's clients were surprised. Fidelity Investments, broker to Main Street, pushed the Department of Labor in 2022 to muzzle the latter's serious concerns over plans, including those by Fidelity, to include Bitcoin as an option for 401k sponsors. If it ultimately succeeds, crypto will become part of the nest egg set aside for workers' retirements. According to the federal pension statute ERISA, retirement plan sponsors, many of whom are Fidelity clients, must adhere to an exacting standard of professionalism, which requires that the investment options offered to participants are prudent. Fidelity would not comment on whether cryptocurrency was prudent. If sponsors want it, they will sell it. On its website, Fidelity describes Bitcoin as an aspirational store of value. Perhaps it imagines that senior citizens will retire on their aspirations. Not unlike the speculative markets in Graham's day, crypto has been virtually unregulated. The field attracted huckstering reminiscent of the salesman in the 1920s. Back then, Charles E. Mitchell, a.k.a. Sunshine Charlie, the president of National City Bank, floated hundreds of millions worth of securities, including highly speculative Peruvian bonds, to small investors. Come the crash, many were wiped out. In the benighted modern era, Michael Saylor, CEO of MicroStrategy, borrowed $2.4 billion and also issued shares, the proceeds of which he plowed into more than $3 billion of Bitcoin. Saylor urged disciples to take all your money and buy Bitcoin, then figure out how to borrow more money to buy more Bitcoin. Saylor's digital evangelism appealed to investors' faith, not their reason. It was the polar opposite of Graham and Dodd fundamental analysis. After Bitcoin's price fell by 2/3, MicroStrategy stock crashed and Saylor resigned. Another promoter, Mike Novogratz, had run a hedge fund but shuttered it after heavy losses, only to reemerge as CEO of Galaxy Digital, selling crypto investment funds. Novogratz became a missionary at crypto conferences and on television and social media, promoting digital currencies with born-again faith. He said at a Bitcoin convention that his role was to preach without end, explaining, "I can't stop." Galaxy made a large investment in a new coin known as Luna, priced at less than $1. As investors, including many small retail investors, jumped aboard, Luna surged to $100. Novogratz triumphantly tweeted, "I'm officially a lunatic." The tweet included a tattooed image of a wolf baying at the moon on his left biceps. Months later, investors panicked and Luna plunged by 99%. Investors lost billions of dollars. After the crash, Novogratz insisted in an interview that his ravings had included words of caution, though he conceded, "It's painful to me that too many people lost too much." Luna's collapse was part of a reckoning for so-called crypto banks, which offered very high yields to investors who deposited crypto assets. One such firm was Celsius Network, which paid 7% interest on loans of crypto coins, which it lent out at even higher rates. At the time, ordinary banks were yielding less than 1%. Critics questioned how such yields could be sustained. Another ersatz bank, Voyager Digital, misleadingly implied that investor deposits were FDIC insured. Its marketing material promised, "In the rare event your USD funds are compromised due to the company or our banking partner's failure, you are guaranteed a full reimbursement up to $250,000. Voyager offered 9% yields and was flooded with deposits. It characterized its approach to asset management as low risk. Mark Cuban, owner of the NBA's Dallas Mavericks, made Voyager an official sponsor. He egged on fans to trade on the Voyager platform, assuring them that Voyager was a perfect fit for our Mavs fans, as close to risk-free as you're going to get in the crypto universe. Voyager and Celsius each borrowed on the order of $5 billion. Some investors believed their deposits were safe, but crypto banks were not legally banks. They were not FDIC insured, and most were highly leveraged. Voyager had a ratio of assets to equity of 23-1, Celsius 19-1. That was less than half the equity cushion of the median traditional bank. Nonetheless, Alex Mashinsky, the founder of Celsius, maintained that his firm offered a better deal for the customer. For 700 years of banking, he said, there was never an option. After those 700 years, the crypto market crashed and investors withdrew funds en masse. Voyager and Celsius suspended withdrawals. Each filed for bankruptcy. Crypto checked off almost every Graham test for speculation. Utter reliance on the market trend, no discernible intrinsic value, high leverage. As in the 1920s, salesmen did not even discuss the issue of valuation. Rather, they touted crypto as the hallmark of a new era. Companies in the business of promoting and trading crypto proved adept at recruiting celebrity endorsers, such as NFL quarterback Tom Brady and comedian Larry David. Numerous retired government regulators joined the boards of crypto firms, giving the industry a patina of institutional stability. Coinbase, the largest U.S.-based crypto exchange, recruited to its board Catherine Hahn, formerly Assistant U.S. Attorney and Digital Currency Coordinator at the U.S. Department of Justice. Coinbase went public in 2021 at a stratospheric price of $381 or $86 billion. After the IPO, 4 company insiders sold $1.2 billion of stock at prices ranging from $189 to $422. In 2022, the company's revenue plunged and the stock crashed to under 100. With a measure of Graham-like detachment, we can see that the crypto bubble is an offshoot of the rise of a technological elite. The impact of technology has been so profound that its experts have come to be regarded as modern priests, akin to the soothsayers of old, and its companies judged on a different standard, as if immune to the age-old test of price and value. The complexity of software, its opaqueness to the non-expert, affords them an immunity to traditional measures of value. For who can appraise what they cannot comprehend? The fact that many technology businesses grew at unusually high rates and did so over long periods nurtured a reasonable premise that these businesses were uncommonly valuable. Under the influence of persistently bullish trends, this premise was exchanged, at times unconsciously, for one that was far less reasonable, that high growth rates were a fixed fact of the industry, and that leading technology stocks were worthy investments at any price. This resembled the philosophy behind the one-decision stocks of the late 1960s and early 1970s, also known as the Nifty 50, blue chips such as ITT, Avon, and Polaroid. These were supposedly one-decision stocks that could be bought and held forever. But peak to trough, the Nifty 50 would plunge 80%. While the one-decision credo was less explicit in the digital era, its application was similar, with consequent inflation of share prices, even relative to digital's growing economic importance. Over the early part of the century, the digital share of America's GDP rose by 1/3 to approximately 10%. While that was impressive, it was outpaced by the action in the stock market, where technology's share of the S&P 500 was 28%. A Graham and Dodd investor would hardly shirk technology, but he or she would be cognizant that prices will not trade without some relation to value, or not forever. Over the first 8 months of 2022, the tech-heavy NASDAQ lost 1/4 of its value. Many digital icons fell by more than half. The market rout of 2022 was illustrative because it stemmed not from a shift in the speculative winds, but rather from verities in the underlying economy. Technology had been treated as exceptional. It was seen as impervious to ordinary economic cycles. In 2022, however, one high-flying technology company after another reported slowing revenues and/or profits, increased competition, and pressure from the slowing economy and worldwide supply interruptions. In other words, all of the same pressures faced in other industries. The Economist magazine was moved to wonder whether the era of big tech exceptionalism was over. A Graham and Dodd investor would bet neither for nor against such a broad brush proposition. The Graham discipline teaches bottom-up security selection based on research into specific securities. Ultimately, what counts is prospective earnings and free cash flow deduced with a reliable margin of safety. Absent such assurance, Graham counseled, securities were not investments at all. They were speculations. Meme stocks, the excesses in private equity valuations, SPACs, crypto, and high leverage lending by phony crypto banks were all variations on this speculative theme. Perhaps securities markets, captive to some faulty wiring in human behavior, are bound forever to repeat such follies. Perhaps human society will be capable of making modest improvements. Until that day, the reader of this volume will profit no less than the reader in 1934. As the review of security analysis that appeared in the New York Times said, on the assumption that despite the debacle of recent history there are still left people whose money burns a hole in their pockets, it is to be hoped that they will read this book. It is a full-bodied, mature, meticulous, and wholly meritorious outgrowth of scholarly probing and practical sagacity. Chapter 1. The Scope and Limitations of Security Analysis. The Concept of Intrinsic Value. Analysis connotes the careful study of available facts with the attempt to draw conclusions therefrom based on established principles and sound logic. It is part of the scientific method. But in applying analysis to the field of securities, we encounter the serious obstacle that investment is by nature not an exact science. The same is true, however, of law and medicine, for here also both individual skill, art, and chance are important factors in determining success or failure. Nevertheless, in these professions, analysis is not only useful but indispensable, so that the same should probably be true in the field of investment and possibly in that of speculation. In the last 3 decades, the prestige of security analysis in Wall Street has experienced both a brilliant rise and an ignominious fall, a history related but by no means parallel to the course of stock prices. The advance of security analysis proceeded uninterruptedly until about 1927, covering a long period in which increasing attention was paid on all sides to financial reports and statistical data. But the new era commencing in 1927 involved at bottom the abandonment of the analytical approach, and while emphasis was still seemingly placed on facts and figures, these were manipulated by a sort of pseudo-analysis to support the delusions of the period. The market collapse in October 1929 was no surprise to such analysts as had kept their heads, but the extent of the business collapse which later developed, with its devastating effects on established earning power, again threw their calculations out of gear. Hence, the ultimate result was that serious analysis suffered a double discrediting. The first, prior to the crash, due to the persistence of imaginary values, and the second, after the crash, due to the disappearance of real values. The experiences of 1927 through 1933 were of so extraordinary a character that they scarcely provide a valid criterion for judging the usefulness of security analysis. As to the years since 1933, there is perhaps room for a difference of opinion. In the field of bonds and preferred stocks, we believe that sound principles of selection and rejection have justified themselves quite well. In the common stock arena, the partialities of the market have tended to confound the conservative viewpoint, and conversely, many issues appearing cheap under analysis have given a disappointing performance. On the other hand, the analytical approach would have given strong grounds for believing representative stock prices to be too high in early 1937 and too low a year later. 3 functions of analysis. 1. Descriptive function. The functions of security analysis may be described under 3 headings: descriptive, selective, and critical. In its more obvious form, descriptive analysis consists of marshaling the important facts relating to an issue and presenting them in a coherent, readily intelligible manner. This function is adequately performed for the entire range of marketable corporate securities by the various manuals, the Standard Statistics and Fitch services, and others. A more penetrating type of description seeks to reveal the strong and weak points in the position of an issue compare its exhibit with that of others of similar character, and appraise the factors which are likely to influence its future performance. Analysis of this kind is applicable to almost every corporate issue, and it may be regarded as an adjunct not only to investment, but also to intelligent speculation in that it provides an organized factual basis for the application of judgment. 2. The selective function of security analysis. In its selective function, security analysis goes further and expresses specific judgments of its own. It seeks to determine whether a given issue should be bought, sold, retained, or exchanged for some other. What types of securities or situations lend themselves best to this more positive activity of the analyst, and to what handicaps or limitations is it subject? It may be well to start with a group of examples of analytical judgments, which could later serve as a basis for more general inquiry. Examples of analytical judgments. In 1928, the public was offered a large issue of 6% non-cumulative preferred stock of St. Louis San Francisco Railway Company priced at $100. The record showed that in no year in the company's history had earnings been equivalent to as much as 1.5 times the fixed charges and preferred dividends combined. The application of well-established standards of selection to the facts in this case would have led to the rejection of the issue as insufficiently protected. A contrasting example. In June 1932, it was possible to purchase 5% bonds of Owens, Illinois Glass Company, due 1939 at 70, yielding 11% to maturity. The company's earnings were many times the interest requirements, not only on the average, but even at that time of severe depression. The bond issue was amply covered by current assets alone, and it was followed by common and preferred stock with a very large aggregate market value, taking their lowest quotations. Here, analysis would have led to the recommendation of this issue as a strongly entrenched and attractively priced investment. Let us take an example from the field of common stocks. In 1922, prior to the boom in aviation securities, Wright Aeronautical Corporation stock was selling on the New York Stock Exchange at only $8, although it was paying a $1 dividend, had for some time been earning over $2 a share, and showed more than $8 per share in cash assets in the Treasury. In this case, analysis would readily have established that the intrinsic value of the issue was substantially above the market price. Again, consider the same issue in 1928 when it had advanced to $280 per share. It was then earning at the rate of $8 per share as against $3.77 in 1927. The dividend rate was $2. The net asset value was less than $50 per share. A study of this picture must have shown conclusively that the market price represented for the most part the capitalization of entirely conjectural future prospects. In other words, that the intrinsic value was far less than the market quotation. A third kind of analytical conclusion may be illustrated by a comparison of Interborough Rapid Transit Company, First, and refunding fives with the same company's collateral 7% notes, when both issues were selling at the same price, say 62, in 1933. The 7% notes were clearly worth considerably more than the fives. Each $1,000 note was secured by a deposit of $1,736 face amount of fives. The principal of the notes had matured. They were entitled either to be paid off in full or to a sale of the collateral for their benefit. The annual interest received on the collateral was equal to about $87 on each 7% note, which amount was actually being distributed to the note holders, so that the current income on the sevens was considerably greater than that on the fives. Whatever technicalities might be invoked to prevent the note holders from asserting their contractual rights promptly and completely, it was difficult to imagine conditions under which the sevens would not be intrinsically worth considerably more than the fives. A more recent comparison of the same general type could have been drawn between Paramount Pictures' first convertible preferred selling at $113 in October 1936 and the common stock concurrently selling at 15 7/8. The preferred stock was convertible at the holder's option into 7 times as many shares of common, and it carried accumulated dividends of about $11 per share. Obviously, the preferred was cheaper than the common, since it would have to receive very substantial dividends before the common received anything, and it could also share fully in any rise of the common by reason of the conversion privilege. If a common stockholder had accepted this analysis and exchanged his shares for 1/7 as many preferred, he would soon have realized a large gain both in dividends received and in principal value. Intrinsic value versus price. From the foregoing examples, it will be seen that the work of the securities analyst is not without concrete results of considerable practical value, and that it is applicable to a wide variety of situations. In all of these instances, he appears to be concerned with the intrinsic value of the security, and more particularly with the discovery of discrepancies between the intrinsic value and the market price. We must recognize, however, that intrinsic value is an elusive concept. In general terms, it is understood to be that value which is justified by the facts. For example, the assets, earnings, dividends, definite prospects, as distinct, let us say, from market quotations established by artificial manipulation or distorted by psychological excesses. But it is a great mistake to imagine that intrinsic value is as definite and as determinable as is the market price. Some time ago, intrinsic value, in the case of a common stock, was thought to be about the same thing as book value. That is, it was equal to the net assets of the business fairly priced. This view of intrinsic value was quite definite, but it proved almost worthless as a practical matter because neither the average earnings nor the average market price evinced any tendency to be governed by the book value. Intrinsic value and earning power. Hence, this idea was superseded by a newer view, viz., that the intrinsic value of a business was determined by its earning power. But the phrase earning power must imply a fairly confident expectation of certain future results. It is not sufficient to know what the past earnings have averaged or even that they disclose a definite line of growth or decline. There must be plausible grounds for believing that this average or this trend is a dependable guide to the future. Experience has shown only too forcibly that in many instances this is far from true. This means that the concept of earning power, expressed as a definite figure, and the derived concept of intrinsic value, as something equally definite and ascertainable, cannot be safely accepted as a general premise of security analysis. Example. To make this reasoning clearer, let us consider a concrete and typical example. What would we mean by the intrinsic value of J.I. Case Company Common as analyzed, say, early in 1933? The market price was $30. The asset value per share was $176. No dividend was being paid. The average earnings for 10 years had been $9.50 per share. The results for 1932 had shown a deficit of $17 per share. If we followed a customary method of appraisal, we might take the average earnings per share of common for 10 years, multiply this average by 10, and arrive at an intrinsic value of $95. But let us examine the individual figures which make up this 10-year average. They are shown in the table on page 66, also found in the accompanying PDF. The average of $9.50 is obviously nothing more than an arithmetical resultant from 10 unrelated figures. It can hardly be urged that this average is in any way representative of typical conditions in the past or representative of what may be expected in the future. Hence, any figure of real or intrinsic value derived from this average must be characterized as equally accidental or artificial. The role of intrinsic value in the work of the analyst. Let us try to formulate a statement of the role of intrinsic value in the work of the analyst which will reconcile the rather conflicting implications of our various examples. The essential point is that security analysis does not seek to determine exactly what is the intrinsic value of a given security. It needs only to establish either that the value is adequate, for example, to protect a bond or to justify a stock purchase, or else that the value is considerably higher or considerably lower than the market price. For such purposes, an indefinite and approximate measure of the intrinsic value may be sufficient. To use a homely simile, it is quite possible to decide by inspection that a woman is old enough to vote without knowing her age, or that a man is heavier than he should be without knowing his exact weight. This statement of the case may be made clearer by a brief return to our examples. The rejection of St. Louis San Francisco Preferred did not require an exact calculation of the intrinsic value of this railroad system. It was enough to show, very simply, from the earnings record, that the margin of value above the bondholders' and preferred stockholders' claims was too small to assure safety. Exactly the opposite was true for the Owens, Illinois Glass Fives. In this instance also, it would undoubtedly have been difficult to arrive at a fair valuation of the business, but it was quite easy to decide that this value in any event was far in excess of the company's debt. In the Wright Aeronautical example, the earlier situation presented a set of facts which demonstrated that the business was worth substantially more than $8 per share, or $1,800,000. In the later year, the facts were equally conclusive that the business did not have a reasonable value of $280 per share, or $70 million in all. It would have been difficult for the analysts to determine whether Wright Aeronautical was actually worth $20 or $40 a share in 1922, or actually worth $50 or $80 in 1929. But fortunately, it was not necessary to decide these points in order to conclude that the shares were attractive at $8 and unattractive intrinsically at $280. The J.I. case example illustrates the far more typical common stock situation in which the analyst cannot reach a dependable conclusion as to the relation of intrinsic value to market price. But even here, if the price had been low or high enough, a conclusion might have been warranted. To express the uncertainty of the picture, we might say that it was difficult to determine in early 1933 whether the intrinsic value of Case Common was nearer $30 or $130. Yet if the stock had been selling at as low as $10, the analyst would undoubtedly have been justified in declaring that it was worth more than the market price. Flexibility of the concept of intrinsic value. This should indicate how flexible is the concept of intrinsic value as applied to security analysis. Our notion of the intrinsic value may be more or less distinct depending on the particular case. The degree of indistinctness may be expressed by a very hypothetical range of approximate value, which would grow wider as the uncertainty of the picture increased. For example, $20 to $40 for Wright Aeronautical in 1922, as against $30 to $130 for Case in 1933. It would follow that even a very indefinite idea of the intrinsic value may still justify a conclusion if the current price falls far outside either the maximum or minimum appraisal. More definite concept in special cases. The interborough rapid transit example permits a more precise line of reasoning than any of the others. Here, a given market price for the 5% bonds results in a very definite valuation for the 7% notes. If it were certain that the collateral securing the notes would be acquired for and distributed to the note holders, then the mathematical relationship, viz. $1,736 of value for the 7s against $1,000 of value for the 5s, would eventually be established at this ratio in the market. But because of quasi-political complications in the picture, this normal procedure could not be expected with certainty. As a practical matter, therefore, it is not possible to say that the 7s are actually worth 74% more than the 5s, but it may be said with assurance that the 7s are worth substantially more, which is a very useful conclusion to arrive at when both issues are selling at the same price. The interborough issues are an example of a rather special group of situations in which analysis may reach more definite conclusions respecting intrinsic value than in the ordinary case. These situations may involve a liquidation or give rise to technical operations known as arbitrage or hedging. While viewed in the abstract, they are probably the most satisfactory field for the analyst's work. The fact that they are specialized in character and of infrequent occurrence makes them relatively unimportant from the broader standpoint of investment theory and practice. Principal obstacles to success of the analyst. A. Inadequate or incorrect data. Needless to say, the analyst cannot be right all the time. Furthermore, a conclusion may be logically right, but work out badly in practice. The main obstacles to the success of the analyst's work are threefold, viz. 1. The inadequacy or incorrectness of the data. 2. The uncertainties of the future. And 3. The irrational behavior of the market. The first of these drawbacks, although serious, is the least important of the three. Deliberate falsification of the data is rare. Most of the misrepresentation flows from the use of accounting artifices, which it is the function of the capable analyst to detect. Concealment is more common than misstatement. But the extent of such concealment has been greatly reduced as the result of regulations, first of the New York Stock Exchange and later of the SEC, requiring more complete disclosure and fuller explanation of accounting practices. Where information on an important point is still withheld, the analyst's experience and skill should lead him to note this defect and make allowance therefor, if indeed he may not elicit the facts by proper inquiry and pressure. In some cases, no doubt, the concealment will elude detection and give rise to an incorrect conclusion. B. Uncertainties of the future. Of much greater moment is the element of future change. A conclusion warranted by the facts and by the apparent prospects may be vitiated by new developments. This raises the question of how far it is the function of security analysis to anticipate changed conditions. We shall defer consideration of this point until our discussion of various factors entering into the processes of analysis. It is manifest, however, that future changes are largely unpredictable, and that security analysis must ordinarily proceed on the assumption that the past record affords at least a rough guide to the future. The more questionable this assumption, the less valuable is the analysis. Hence, this technique is more useful when applied to senior securities, which are protected against change, than to common stocks, more useful when applied to a business of inherently stable character than to one subject to wide variations, and finally, more useful when carried on under fairly normal general conditions than in times of great uncertainty and radical change. C. The irrational behavior of the market. The third handicap to security analysis is found in the market itself. In a sense, the market and the future present the same kind of difficulties. Neither can be predicted or controlled by the analyst, yet his success is largely dependent upon them both. The major activities of the investment analyst may be thought to have little or no concern with market prices. His typical function is the selection of high-grade, fixed income-bearing bonds, which upon investigation he judges to be secure as to interest and principal. The purchaser is supposed to pay no attention to their subsequent market fluctuations, but to be interested solely in the question whether the bonds will continue to be sound investments. In our opinion, this traditional view of the investor's attitude is inaccurate and somewhat hypocritical. Owners of securities, whatever their character, are interested in their market quotations. This fact is recognized by the emphasis always laid in investment practice upon marketability. If it is important that an issue be readily saleable, it is still more important that it command a satisfactory price. While for obvious reasons the investor in high-grade bonds has a lesser concern with market fluctuations than has the speculator, they still have a strong psychological, if not financial, effect upon him. Even in this field, therefore, the analyst must take into account whatever influences may adversely govern the market price, as well as those which bear upon the basic safety of the issue. In that portion of the analyst's activities which relates to the discovery of undervalued and possibly of overvalued securities, he is more directly concerned with market prices. For here, the vindication of his judgment must be found largely in the ultimate market action of the issue. This field of analytical work may be said to rest upon a twofold assumption. First, that the market price is frequently out of line with the true value, and second, that there is an inherent tendency for these disparities to correct themselves. As to the truth of the former statement, there can be very little doubt. Even though Wall Street often speaks glibly of the infallible judgment of the market and asserts that a stock is worth what you can sell it for, neither more nor less. The hazard of tardy adjustment of price value. The second assumption is equally true in theory, but its working out in practice is often most unsatisfactory. Undervaluations caused by neglect or prejudice may persist for an inconveniently long time, and the same applies to inflated prices caused by overenthusiasm or artificial stimulants. The particular danger to the analyst is that, because of such delay, new determining factors may supervene before the market price adjusts itself to the value as he found it. In other words, by the time the price finally does reflect the value, this value may have changed considerably, and the facts and reasoning on which his decision was based may no longer be applicable. The analyst must seek to guard himself against this danger as best he can, in part by dealing with those situations preferably which are not subject to sudden change, in part by favoring securities in which the popular interest is keen enough to promise a fairly swift response to value elements which he is the first to recognize, in part by tempering his activities to the general financial situation, laying more emphasis on the discovery of undervalued securities when business and market conditions are on a fairly even keel, and proceeding with greater caution in times of abnormal stress and uncertainty. The relationship of intrinsic value to market price. The general question of the relation of intrinsic value to the market quotation may be made clearer by the following chart, which traces the various steps culminating in the market price. It will be evident from the chart that the influence of what we call analytical factors over the market price is both partial and indirect. Partial because it frequently competes with purely speculative factors which influence the price in the opposite direction, and indirect because it acts through the intermediary of people's sentiments and decisions. In other words, the market is not a weighing machine on which the value of each issue is recorded by an exact and impersonal mechanism in accordance with its specific qualities. Rather, should we say that the market is a voting machine whereon countless individuals register choices which are the product partly of reason and partly of emotion. Analysis and speculation. It may be thought that sound analysis should produce successful results in any type of situation, including the confessedly speculative, that is, those subject to substantial uncertainty and risk. If the selection of speculative issues is based on expert study of the company's position, should not this approach give the purchaser a considerable advantage? Admitting future events to be uncertain, could not the favorable and unfavorable developments be counted on to cancel out against each other, more or less, so that the initial advantage afforded by sound analysis will carry through into an eventual average profit? This is a plausible argument, but a deceptive one, and its over-ready acceptance has done much to lead analysts astray. It is worthwhile, therefore, to detail several valid arguments against placing chief reliance upon analysis in speculative situations. In the first place, what may be called the mechanics of speculation involves serious handicaps to the speculator, which may outweigh the benefits conferred by analytical study. These disadvantages include the payment of commissions and interest charges, the so-called turn of the market, meaning the spread between the bid and asked price, and, most important of all, an inherent tendency for the average loss to exceed the average profit, unless a certain technique of trading is followed, which is opposed to the analytical approach. The second objection is that the underlying analytical factors in speculative situations are subject to swift and sudden revision. The danger, already referred to, that the intrinsic value may change before the market price reflects that value, is therefore much more serious in speculative than in investment situations. A third difficulty arises from circumstances surrounding the unknown factors which are necessarily left out of security analysis. Theoretically, these unknown factors should have an equal chance of being favorable or unfavorable, and thus they should neutralize each other in the long run. For example, it is often easy to determine by comparative analysis that one company is selling much lower than another in the same field, in relation to earnings, although both apparently have similar prospects. But it may well be that the low price for the apparently attractive issue is due to certain important unfavorable factors which, though not disclosed, are known to those identified with the company, and vice versa, for the issue seemingly selling above its relative value. In speculative situations, those on the inside often have an advantage of this kind, which nullifies the premise that good and bad changes in the picture should offset each other, and which loads the dice against the analyst working with some of the facts concealed from him. The value of analysis diminishes as the element of chance increases. The final objection is based on more abstract grounds, but nevertheless its practical importance is very great. Even if we grant that analysis can give the speculator a mathematical advantage, it does not assure him a profit. His ventures remain hazardous. In any individual case, a loss may be taken, and after the operation is concluded, it is difficult to determine whether the analyst's contribution has been a benefit or a detriment. Hence, the latter's position in the speculative field is at best uncertain and somewhat lacking in professional dignity. It is as though the analyst and Dame Fortune were playing a duet on the speculative piano, with the fickle goddess calling all the tunes. By another and less imaginative simile, we might more convincingly show why analysis is inherently better suited to investment than to speculative situation. In anticipation of a more detailed inquiry in a later chapter, we have assumed throughout this chapter that investment implies expected safety, and speculation connotes acknowledged risk. In Monte Carlo, the odds are weighted 19-18 in favor of the proprietor of the roulette wheel, so that on the average he wins $1 out of each 37 wagered by the public. This may suggest the odds against the untrained investor or speculator. Let us assume that, through some equivalent of analysis, a roulette player is able to reverse the odds for a limited number of wagers, so that they are now 18-19 in his favor. If he distributes his wagers evenly over all the numbers, then whichever one turns up, he is certain to win a moderate amount. This operation may be likened to an investment program based upon sound analysis and carried on under propitious general conditions. But if the player wagers all his money on a single number, the small odds in his favor are of slight importance compared with the crucial question whether chance will elect the number he has chosen. His analysis will enable him to win a little more if he is lucky. It will be of no value when luck is against him. This, in slightly exaggerated form perhaps, describes the position of the analyst dealing with essentially speculative operations. Exactly the same mathematical advantage which practically assures good results in the investment field may prove entirely ineffective where luck is the overshadowing influence. It would seem prudent, therefore, to consider analysis as an adjunct or auxiliary rather than as a guide in speculation. It is only where chance plays a subordinate role that the analyst can properly speak in an authoritative voice and accept responsibility for the results of his judgments. 3. The critical function of security analysis. The principles of investment finance and the methods of corporation finance fall necessarily within the province of security analysis. Analytical judgments are reached by applying standards to facts. The analyst is concerned, therefore, with the soundness and practicability of the standards of selection. He is also interested to see that securities, especially bonds and preferred stocks, be issued with adequate protective provisions and, more important still, that proper methods of enforcement of these covenants be part of accepted financial practice. It is a matter of great moment to the analyst that the facts be fairly presented, and this means that he must be highly critical of accounting methods. Finally, he must concern himself with all corporate policies affecting the security owner, for the value of the issue which he analyzes may be largely dependent upon the acts of the management. In this category are included questions of capitalization setup, of dividend and expansion policies, of managerial compensation, and even of continuing or liquidating an unprofitable business. On these matters of varied import, security analysis may be competent to express critical judgments, looking to the avoidance of mistakes, to the correction of abuses, and to the better protection of those owning bonds or stocks. Chapter 2. Fundamental Elements in the Problem of Analysis, Quantitative and Qualitative Factors. In the previous chapter, we referred to some of the concepts and materials of analysis from the standpoint of their bearing on what the analyst may hope to accomplish. Let us now imagine the analyst at work and ask what are the broad considerations which govern his approach to a particular problem, and also what should be his general attitude toward the various kinds of information with which he has had to deal. 4 fundamental elements. The object of security analysis is to answer or assist in answering certain questions of a very practical nature. Of these, perhaps the most customary are the following. What securities should be bought for a given purpose? Should issue S be bought, or sold, or retained? In all such questions, 4 major factors may be said to enter, either expressly or by implication. These are 1. The security, 2. The price, 3. The time, 4. The person. More completely stated, the second typical question would run, should security S be bought, or sold, or retained at price P at this time, T, by individual I. Some discussion of the relative significance of these 4 factors is therefore pertinent, and we shall find it convenient to consider them in inverse order. The personal element. The personal element enters to a greater or lesser extent into every security purchase. The aspect of chief importance is usually the financial position of the intending buyer. What might be an attractive speculation for a businessman should under no circumstances be attempted by a trustee or a widow with limited income. Again, United States Liberty 3 1/2 should not have been purchased by those to whom their complete tax exemption feature was of no benefit, when a considerably higher yield could be obtained from partially taxable governmental issues. Other personal characteristics that on occasion might properly influence the individual's choice of securities are his financial training and competence, his temperament, and his preferences. But however vital these considerations may prove at times, they are not ordinarily determining factors in analysis. Most of the conclusions derived from analysis can be stated in impersonal terms, as applicable to investors or speculators as a class. The time. The time at which an issue is analyzed may affect the conclusion in various ways. The company's showing may be better, or its outlook may seem better at one time than another, and these changing circumstances are bound to exert a varying influence on the analyst's viewpoint toward the issue. Furthermore, securities are selected by the application of standards of quality and yield, and both of these, particularly the latter, will vary with financial conditions in general. A railroad bond of highest grade yielding 5% seemed attractive in June 1931 because the average return on this type of bond was 4.32%. But the same offering made 6 months later would have been quite unattractive, for in the meantime bond prices had fallen severely and the yield on this group had increased to 5.86%. Finally, nearly all security commitments are influenced to some extent by the current view of the financial and business outlook. In speculative operations, these considerations are of controlling importance, and while conservative investment is ordinarily supposed to disregard these elements, in times of stress and uncertainty they may not be ignored. Security analysis, as a study, must necessarily concern itself as much as possible with principles and methods which are valid at all times, or at least under all ordinary conditions. It should be kept in mind, however, that the practical applications of analysis are made against a background largely colored by the changing times. The price. The price is an integral part of every complete judgment relating to securities. In the selection of prime investment bonds, the price is usually a subordinate factor, not because it is a matter of indifference, but because in actual practice the price is rarely unreasonably high. Hence, almost entire emphasis is placed on the question whether the issue is adequately secured. But in a special case, such as the purchase of high-grade convertible bonds, the price may be a factor fully as important as the degree of security. This point is illustrated by the American Telephone and Telegraph Company convertible 4.5s, due 1939, which sold above 200 in 1929. The fact that principal, at par, and interest were safe beyond question did not prevent the issue from being an extremely risky purchase at that price, one which in fact was followed by the loss of over half its market value. In the field of common stocks, the necessity of taking price into account is more compelling because the danger of paying the wrong price is almost as great as that of buying the wrong issue. We shall point out later that the new era theory of investment left price out of the reckoning, and that this omission was productive of most disastrous consequences. The security, character of the enterprise, and the terms of the commitment. The roles played by the security and its price in an investment decision may be set forth more clearly if we restate the problem in somewhat different form. Instead of asking 1. In what security, and 2. At what price, let us ask 1. In what enterprise, and 2. On what terms is the commitment proposed? This gives us a more comprehensive and evenly balanced contrast between two basic elements in analysis. By the terms of the investment or speculation, we mean not only the price, but also the provisions of the issue and its status or showing at the time. Example of commitment on unattractive terms. An investment in the soundest type of enterprise may be made on unsound and unfavorable terms. Prior to 1929, the value of urban real estate had tended to grow steadily over a long period of years. Hence, it came to be regarded by many as the safest medium of investment. But the purchase of a preferred stock in a New York City real estate development in 1929 might have involved terms of investment so thoroughly disadvantageous as to banish all elements of soundness from the proposition. One such stock offering could be summarized as follows. 1. Provisions of the issue. A preferred stock, ranking junior to a large first mortgage, and without unqualified rights to dividend or principal payments. It ranked ahead of a common stock which represented no cash investment, so that the common stockholders had nothing to lose and a great deal to gain, while the preferred stockholders had everything to lose and only a small share in the possible gain. 2. Status of the issue. A commitment in a new building constructed at an exceedingly high level of costs with no reserves or junior capital to fall back upon in case of trouble. 3. Price of the issue. At par, the dividend return was 6%, which was much less than the yield obtainable on real estate second mortgages, having many other advantages over this preferred stock. Example of a commitment on attractive terms. We have only to examine electric power and light financing in recent years to find countless examples of unsound securities in a fundamentally attractive industry. By way of contrast, let us cite the case of Brooklyn Union Elevated Railroad First Fives, due 1950, which sold in 1932 at 60 to yield 9.85% to maturity. They are an obligation of the Brooklyn-Manhattan Transit System. The traction or electric railway industry has long been unfavorably regarded, chiefly because of automobile competition, but also on account of regulation and fair contract difficulties. Hence, this security represents a comparatively unattractive type of enterprise. Yet the terms of the investment here might well make it a satisfactory commitment, as shown by the following. 1. Provisions of the issue. By contract between the operating company and the City of New York, this was a first charge on the earnings of the combined subway and elevated lines of the system, both company and city-owned, representing an investment enormously greater than the size of this issue. 2. Status of the issue. Apart from the very exceptional specific protection just described, the bonds were obligations of a company with stable and apparently fully adequate earning power. 3. Price of the issue. It could be purchased to yield somewhat more than the Brooklyn-Manhattan Transit Corporation 6s, due 1968, which occupied a subordinate position. At the low price of $68 for the latter issue in 1932, its yield was 9% against 9.85% for the Brooklyn Union Elevated 5s. Relative importance of the terms of the commitment and the character of the enterprise. Our distinction between the character of the enterprise and the terms of the commitment suggests a question as to which element is the more important. Is it better to invest in an attractive enterprise on unattractive terms or in an unattractive enterprise on attractive terms? The popular view unhesitatingly prefers the former alternative, and in so doing it is instinctively, rather than logically, right. Over a long period, experience will undoubtedly show that less money has been lost by the great body of investors through paying too high a price for securities of the best-regarded enterprises than by trying to secure a larger income or profit from commitments in enterprises of lower grade. From the standpoint of analysis, however, this empirical result does not dispose of the matter. It merely exemplifies a rule that is applicable to all kinds of merchandise, viz., that the untrained buyer fares best by purchasing goods of the highest reputation, even though he may pay a comparatively high price. But needless to say, this is not a rule to guide the expert merchandise buyer, for he is expected to judge quality by examination and not solely by reputation. And at times he may even sacrifice certain definite degrees of quality if that which he obtains is adequate for his purpose and attractive in price. This distinction applies as well to the purchase of securities as to buying paints or watches. It results in two principles of quite opposite character, the one suitable for the untrained investor, the other useful only to the analyst. 1. Principle for the untrained security buyer. Do not put money in a low-grade enterprise on any terms. 2. Principle for the securities analyst. Nearly every issue might conceivably be cheap in one price range and dear in another. We have criticized the placing of exclusive emphasis on the choice of the enterprise on the ground that it often leads to paying too high a price for a good security. A second objection is that the enterprise itself may prove to be unwisely chosen. It is natural and proper to prefer a business which is large and well managed, has a good record, and is expected to show increasing earnings in the future. But these expectations, though seemingly well-founded, often fail to be realized. Many of the leading enterprises of yesterday are today far back in the ranks. Tomorrow is likely to tell a similar story. The most impressive illustration is afforded by the persistent decline in the relative investment position of the railroads as a class during the past 2 decades. The standing of an enterprise is in part a matter of fact and in part a matter of opinion. During recent years, investment opinion has proved extraordinarily volatile and undependable. In 1929, Westinghouse Electric and Manufacturing Company was quite universally considered as enjoying an unusually favorable industrial position. 2 years later, the stock sold for much less than the net current assets alone, presumably indicating widespread doubt as to its ability to earn any profit in the future. Great Atlantic and Pacific Tea Company, viewed as little short of a miraculous enterprise in 1929, declined from $4.94 in that year to $36 in 1938. At the latter date, the common sold for less than its cash assets, the preferred being amply covered by other current assets. These considerations do not gainsay the principle that untrained investors should confine themselves to the best-regarded enterprises. It should be realized, however, that this preference is enjoined upon them because of the greater risk for them in other directions, and not because the most popular issues are necessarily the safest. The analyst must pay respectful attention to the judgment of the marketplace and to the enterprises which it strongly favors, but he must retain an independent and critical viewpoint. Nor should he hesitate to condemn the popular and espouse the unpopular when reasons sufficiently weighty and convincing are at hand. Qualitative and quantitative factors in analysis. Analyzing a security involves an analysis of the business. Such a study could be carried to an unlimited degree of detail, hence practical judgment must be exercised to determine how far the process should go. The circumstances will naturally have a bearing on this point. A buyer of a $1,000 bond would not deem it worth his while to make as thorough an analysis of an issue as would a large insurance company considering the purchase of a $500,000 block. The latter's study would still be less detailed than that made by the originating bankers. Or, from another angle, a less intensive analysis should be needed in selecting a high-grade bond yielding 3% than in trying to find a well-secured issue yielding 6%, or an unquestioned bargain in the field of common stocks. Technique and extent of analysis should be limited by character and purposes of the commitment. The equipment of the analyst must include a sense of proportion in the use of his technique. In choosing and dealing with the materials of analysis, he must consider not only inherent importance and dependability, but also the question of accessibility and convenience. He must not be misled by the availability of a mass of data. For example, in the reports of the railroads to the Interstate Commerce Commission, into making elaborate studies of non-essentials. On the other hand, he must frequently resign himself to the lack of significant information because it can be secured only by expenditure of more effort than he can spare or the problem will justify. This would be true frequently of some of the elements involved in a complete business analysis, as, for example, the extent to which an enterprise is dependent upon patent protection or geographical advantages or favorable labor conditions which may not endure. Value of data varies with type of enterprise. Most important of all, the analyst must recognize that the value of a particular kind of data varies greatly with the type of enterprise which is being studied. The 5-year record of gross or net earnings of a railroad or a large chain store enterprise may afford, if not a conclusive, at least a reasonably sound basis for measuring the safety of the senior issues and the attractiveness of the common shares. But the same statistics supplied by one of the smaller oil-producing companies may well prove more deceptive than usual, since they are chiefly the resultant of two factors, viz., price received and production, both of which are likely to be radically different in the future than in the past. Quantitative versus qualitative elements in analysis. It is convenient at times to classify the elements entering into an analysis under two headings, the quantitative and the qualitative. The former might be called the company's statistical exhibit. Included in it would be all the useful items in the income account and balance sheet, together with such additional specific data as may be provided with respect to production and unit prices, costs, capacity, unfilled orders, etc. These various items may be subclassified under the headings 1. Capitalization, 2. Earnings and dividends, 3. Assets and liabilities, and 4. Operating statistics. The qualitative factors, on the other hand, deal with such matters as the nature of the business, the relative position of the individual company in the industry, its physical, geographical, and operating characteristics, the character of the management, and finally, the outlook for the unit, for the industry, and for business in general. Questions of this sort are not dealt with ordinarily in the company's reports. The analyst must look for their answers to miscellaneous sources of information of greatly varying dependability, including a large admixture of mere opinion. Broadly speaking, the quantitative factors lend themselves far better to thoroughgoing analysis than do the qualitative factors. The former are fewer in number, more easily obtainable, and much better suited to the forming of definite and dependable conclusions. Furthermore, the financial results will themselves epitomize many of the qualitative elements, so that a detailed study of the latter may not add much of importance to the picture. The typical analysis of a security, as made, say, in a brokerage house circular or in a report issued by a statistical service, will treat the qualitative factors in a superficial or summary fashion and devote most of its space to the figures. Qualitative factors: nature of the business and its future prospects. The qualitative factors upon which most stress is laid are the nature of the business and the character of the management. These elements are exceedingly important, but they are also exceedingly difficult to deal with intelligently. Let us consider first the nature of the business, in which concept is included the general idea of its future prospects. Most people have fairly definite notions as to what is a good business and what is not. These views are based partly on the financial results, partly on knowledge of specific conditions in the industry, and partly also on surmise or bias. During most of the period of general prosperity between 1923 and 1929, quite a number of major industries were backward. These included cigars, coal, cotton goods, fertilizers, leather, lumber, meat packing, paper, shipping, street railways, sugar, woolen goods. The underlying cause was usually either the development of competitive products or services, for example, coal, cotton goods, tractions, or excessive production and demoralizing trade practices, for example, paper, lumber, sugar. During the same period, other industries were far more prosperous than the average. Among these were can manufacturers, chain stores, cigarette producers, motion pictures, public utilities. The chief cause of these superior showings might be found in unusual growth of demand, cigarettes, motion pictures, or in absence or control of competition, public utilities, can makers, or in the ability to win business from other agencies, chain stores. It is natural to assume that industries which have fared worse than the average are unfavorably situated and therefore to be avoided. The converse would be assumed, of course, for those with superior records, but this conclusion may often prove quite erroneous. Abnormally good or abnormally bad conditions do not last forever. This is true not only of general business but of particular industries as well. Corrective forces are often set in motion which tend to restore profits where they have disappeared or to reduce them where they are excessive in relation to capital. Industries especially favored by a developing demand may become demoralized through a still more rapid growth of supply. This has been true of radio, aviation, electric refrigeration, bus transportation, and silk hosiery. In 1922, department stores were very favorably regarded because of their excellent showing in the 1920 to 1921 depression, but they did not maintain this advantage in subsequent years. The public utilities were unpopular in the 1919 boom because of high costs. They became speculative and investment favorites in 1927 through 1929. In 1933 through 1938, fear of inflation, rate regulation, and direct governmental competition again undermined the public's confidence in them. In 1933, on the other hand, the cotton goods industry, long depressed, forged ahead faster than most others. The factor of management. Our appreciation of the importance of selecting a good industry must be tempered by a realization that this is by no means so easy as it sounds. Somewhat the same difficulty is met with in endeavoring to select an unusually capable management. Objective tests of managerial ability are few and far from scientific. In most cases, the investor must rely upon a reputation which may or may not be deserved. The most convincing proof of capable management lies in a superior comparative record over a period of time, but this brings us back to the quantitative data. There is a strong tendency in the stock market to value the management factor twice in its calculations. Stock prices reflect the large earnings which the good management has produced, plus a substantial increment for good management considered separately. This amounts to counting the same trick twice, and it proves a frequent cause of overvaluation. The trend of future earnings. In recent years, increasing importance has been laid upon the trend of earnings. Needless to say, a record of increasing profits is a favorable sign. Financial theory has gone further, however, and has sought to estimate future earnings by projecting the past trend into the future, and then used this projection as a basis for valuing the business. Because figures are used in this process, people mistakenly believe that it is mathematically sound. But while a trend shown in the past is a fact, a future trend is only an assumption. The factors that we mentioned previously as militating against the maintenance of abnormal prosperity or depression are equally opposed to the indefinite continuance of an upward or downward trend. By the time the trend has become clearly noticeable, conditions may well be ripe for a change. It may be objected that as far as the future is concerned, it is just as logical to expect a past trend to be maintained as to expect a past average to be repeated. This is probably true, but it does not follow that the trend is more useful to analysis than the individual or average figures of the past. For security analysis does not assume that a past average will be repeated, but only that it supplies a rough index to what may be expected of the future. A trend, however, cannot be used as a rough index. It represents a definite prediction of either better or poorer results, and it must be either right or wrong. This distinction, important in its bearing on the attitude of the analyst, may be made clear by the use of examples. Let us assume that in 1929 a railroad showed its interest charges earned 3 times on the average during the preceding 7 years. The analyst would have ascribed great weight to this point as an indication that its bonds were sound. This is a judgment based on quantitative data and standards. But it does not imply a prediction that the earnings in the next 7 years will average 3 times interest charges. It suggests only that earnings are not likely to fall so much under 3 times interest charges as to endanger the bonds. In nearly every actual case, such a conclusion would have proved correct despite the economic collapse that ensued. Now let us consider a similar judgment based primarily upon the trend. In 1929, nearly all public utility systems showed a continued growth of earnings, but the fixed charges of many were so heavy, by reason of pyramidal capital structures, that they consumed nearly all the net income. Investors bought bonds of these systems freely on the theory that the small margin of safety was no drawback, since earnings were certain to continue to increase. They were thus making a clear-cut prediction as to the future, upon the correctness of which depended the justification of their investment. If their prediction were wrong, as proved to be the case, they were bound to suffer serious loss. Trend, essentially a qualitative factor. In our discussion of the valuation of common stocks later in this book, we shall point out that the placing of preponderant emphasis on the trend is likely to result in errors of overvaluation or undervaluation. This is true because no limit may be fixed on how far ahead the trend should be projected, and therefore the process of valuation, while seemingly mathematical, is in reality psychological and quite arbitrary. For this reason, we consider the trend as a qualitative factor in its practical implications, even though it may be stated in quantitative terms. Qualitative factors resist even reasonably accurate appraisal. The trend is, in fact, a statement of future prospects in the form of an exact prediction, In similar fashion, conclusions as to the nature of the business and the abilities of the management have their chief significance in their bearing on the outlook. These qualitative factors are therefore all of the same general character. They all involve the same basic difficulty for the analyst, viz., that it is impossible to judge how far they may properly reflect themselves in the price of a given security. In most cases, if they are recognized at all, they tend to be overemphasized. We see the same influence constantly at work in the general market. The recurrent excesses of its advances and declines are due at bottom to the fact that, when values are determined chiefly by the outlook, the resultant judgments are not subject to any mathematical controls and are almost inevitably carried to extremes. Analysis is concerned primarily with values which are supported by the facts, and not with those which depend largely upon expectations. In this respect, the analyst's approach is diametrically opposed to that of the speculator, meaning thereby one whose success turns upon his ability to forecast or to guess future developments. Needless to say, the analyst must take possible future changes into account, but his primary aim is not so much to profit from them as to guard against them. Broadly speaking, he views the business future as a hazard which his conclusions must encounter rather than as the source of his vindication. Inherent stability a major qualitative factor. It follows that the qualitative factor in which the analyst should properly be most interested is that of inherent stability. For stability means resistance to change and hence greater dependability for the results shown in the past. Stability, like the trend, may be expressed in quantitative terms, as, for example, by stating that the earnings of General Baking Company during 1923 through 1932 were never less than 10 times 1932 interest charges, or that the operating profits of Woolworth between 1924 and 1933 varied only between $2.12 and $3.66 per share of common. But in our opinion, stability is really a qualitative trait, because it derives in the first instance from the character of the business and not from its statistical record. A stable record suggests that the business is inherently stable, but this suggestion may be rebutted by other considerations. Examples. This point may be brought out by a comparison of two preferred stock issues as of early 1932, viz., those of Studebaker Motors and of First National grocery stores, both of which were selling above par. The two exhibits were similar in that both disclosed a continuously satisfactory margin above preferred dividend requirements. The Studebaker figures were more impressive, however, as the following table will indicate. But the analyst must penetrate beyond the mere figures and consider the inherent character of the two businesses. The chain store grocery trade contained within itself many elements of relative stability, such as stable demand, diversified locations, and rapid inventory turnover. A typical large unit in this field, provided only it abstained from reckless expansion policies, was not likely to suffer tremendous fluctuations in its earnings. But the situation of the typical automobile manufacturer was quite different. Despite fair stability in the industry as a whole, the individual units were subject to extraordinary variations, due chiefly to the vagaries of popular preference. The stability of Studebaker's earnings could not be held by any convincing logic to demonstrate that this company enjoyed a special and permanent immunity from the vicissitudes to which most of its competitors had shown themselves subject. The soundness of Studebaker Preferred rested, therefore, largely upon a stable statistical showing which was at variance with the general character of the industry so far as its individual units were concerned. On the other hand, the satisfactory exhibit of First National Store's Preferred was in thorough accord with what was generally thought to be the inherent character of the business. The later consideration should have carried great weight with the analyst and should have made First National Store's Preferred appear intrinsically sounder as a fixed-value investment than Studebaker Preferred, despite the more impressive statistical showing of the automobile company. Summary. To sum up this discussion of qualitative and quantitative factors, we may express the dictum that the analyst's conclusions must always rest upon the figures and upon established tests and standards. These figures alone are not sufficient. They may be completely vitiated by qualitative considerations of an opposite import. A security may make a satisfactory statistical showing, but doubt as to the future or distrust of the management may properly impel its rejection. Again, the analyst is likely to attach prime importance to the qualitative element of stability, because its presence means that conclusions based on past results are not so likely to be upset by unexpected developments. It is also true that he will be far more confident in his selection of an issue if he can buttress an adequate quantitative exhibit with unusually favorable qualitative factors. But whenever the commitment depends to a substantial degree upon these qualitative factors, whenever, that is, the price is considerably higher than the figures alone would justify, then the analytical basis of approval is lacking. In the mathematical phrase, a satisfactory statistical exhibit is a necessary, though by no means a sufficient condition for a favorable decision by the analyst. Chapter 3. Sources of Information. It is impossible to discuss or even to list all the sources of information which the analyst may find it profitable to consult at one time or another in his work. In this chapter, we shall present a concise outline of the more important sources, together with some critical observations thereon, and we shall also endeavor to convey, by means of examples, an idea of the character and utility of the large variety of special avenues of information. Data on the terms of the issue. Let us assume that, in the typical case, the analyst seeks data regarding 1. The terms of the specific issue, 2. The company, and 3. The industry. The provisions of the issue itself are summarized in the security manuals or statistical services. For more detailed information regarding a bond contract, the analyst should consult the indenture or deed of trust, a copy of which may be obtained or inspected at the office of the trustee. The terms of the respective stock issues of a company are set forth fully in the charter or articles of incorporation, together with the bylaws. If the stock is listed, these documents are on file with the SEC and also with the proper stock exchange. In the case of both bonds and stocks, the listing applications, which are readily obtainable, contain nearly all the significant provisions. Prospectuses of new issues also contain these provisions. Data on the company. Reports to stockholders, including interim news releases. Coming now to the company, the chief source of statistical data is, of course, the reports issued to the stockholders. These reports vary widely with respect to both frequency and completeness, as the following summary will show. All important railroads supply monthly figures down to net after rentals, net railway operating income. Most carry the results down to the balance for dividends, net income. Many publish car loading figures weekly, and a few have published gross earnings weekly. The pamphlet annual reports publish financial and operating figures in considerable detail. The ruling policy of public utility companies varies between quarterly and monthly statements. Figures regularly include gross, net after taxes, and balance for dividends. Some companies publish only a moving 12-month total. For example, American Water Works and Electric Company, monthly. North American Company, quarterly. Many supply weekly or monthly figures of kilowatt hours sold. Industrials. The practices followed by industrial companies are usually a matter of individual policy. In some industrial groups, there is a tendency for most of the companies therein to follow the same course. 1. Monthly statements. Most chain stores announce their monthly sales in dollars. Prior to 1931, copper producers regularly published their monthly output. General Motors publishes monthly sales in units. Between 1902 and 1933, United States Steel Corporation published its unfilled orders each month, but in 1933 it replaced this figure by monthly deliveries in tons. Baldwin Locomotive Works has published monthly figures of shipments, new orders, and unfilled orders in dollars. The Standard Oil Group of pipeline companies publish monthly statistics of operations in barrels. Monthly figures of net earnings are published by individual companies from time to time, but such practices have tended to be sporadic or temporary. For example, Otis Steel, Mullins Manufacturing, Alaska Juneau. There is a tendency to inaugurate monthly statements during periods of improvements and to discontinue them with earnings decline. Sometimes figures by months are included in the quarterly statements. For example, United States Steel Corporation prior to 1932. 2. Quarterly statements. Publication of results quarterly is considered as the standard procedure in nearly all lines of industry. The New York Stock Exchange has been urging quarterly reports with increasing vigor and has usually been able to make its demands effective in connection with the listing of new or additional securities. Certain types of businesses are considered, or consider themselves, exempt from this requirement because of the seasonal nature of their results. These lines include sugar production, fertilizers, and agricultural implements. Seasonal fluctuations may be concealed by publishing quarterly a moving 12 months figure of earnings. This is done by Continental Can Company. It is not easy to understand why all the large cigarette manufacturers and the majority of department stores should withhold their results for a full year. It is inconsistent also for a company such as Woolworth to publish sales monthly but no interim statements of net profits. Many individual companies belonging to practically every division of industry still fail to publish quarterly reports. In nearly every case, such interim figures are available to the management but are denied to the stockholders without adequate reason. The data given in the quarterly statements vary from a single figure of net earnings, sometimes without allowance for depreciation or federal taxes, to a fully detailed presentation of the income account and the balance sheet with the president's remarks appended. General Motors Corporation is an outstanding example of the latter practice. 3. Semi-annual reports. These do not appear to be standard practice for any industrial group except possibly the rubber companies. A number of individual enterprises report semi-annually, for example, American Locomotive and American Woolen. 4. Annual reports. Every listed company publishes an annual report of some kind. The annual statement is generally more detailed than those covering interim periods. It frequently contains remarks, not always illuminating, by the president or the chairman of the board relating to the past year's results and to the future outlook. The distinguishing feature of the annual report, however, is that it invariably presents the balance sheet position. The information given in the income account varies considerably in extent. Some reports give no more than the earnings available for dividends and the amount of dividends paid. For example, United States Leather Company. The income account. In our opinion, an annual income account is not reasonably complete unless it contains the following items. 1. Sales. 2. Net earnings before the items following. 3. Depreciation and depletion. 4. Interest charges. 5. Non-operating income in detail. 6. Income taxes. 7. Dividends paid. 8. Surplus adjustments in detail. Prior to the passage of the Securities and Exchange Act, it was unfortunately true that less than half of our industrial corporations supplied this very moderate quota of information. By contrast, data relative to railroads and public utilities have long been uniformly adequate. The SEC regulations now require virtually all this information to be published in the original registration statement, Form 10, and the succeeding annual reports, Form 10-K. Quite a number of companies have requested the SEC to keep their sales figures confidential on the ground that publication would be detrimental to the enterprise. Most of these requests have been either withdrawn or denied. The standard of reasonable completeness for annual reports suggested above by no means includes all the information which might be vouchsafed to shareholders. The reports of United States Steel Corporation may be taken as a model of comprehensiveness. The data there supplied embrace, in addition to our standard requirements, the following items. 1. Production and sales in units, rate of capacity operated. 2. Division of sales as between domestic and foreign, intercompany and outsiders. 3. Details of operating expenses, wages, wage rates, and number of employees, state and local taxes paid, selling and general expense, maintenance expenditures, amount and details. 4. Details of capital expenditures during the year. 5. Details of inventories. 6. Details of properties owned. 7. Number of stockholders. The balance sheet. The form of the balance sheet is better standardized than the income account, and it does not offer such frequent grounds for criticism. Formerly, a widespread defect of balance sheets was the failure to separate intangible from tangible fixed assets, but this is now quite rare in the case of listed issues. Among the companies that, since 1935, have disclosed the amount of goodwill formerly included in their property accounts are American Steel Foundries, American Can, Harbison Walker Refractories, Luce Wiles Biscuit, and United States Steel. In nearly all these cases, the goodwill was written off against surplus. Criticism may properly be voiced against the practice of a great many companies in stating only the net figure for their property account without showing the deduction for depreciation. Other shortcomings sometimes met are the failure to state the market value of securities owned. For example, Oppenheim Collins and Company in 1932.